Sure
I'm going to
thing.
start recording just so everybody knows. And at the end, when you have individual questions, I will stop recording to go ahead so those questions won't be viewed externally by others. In case you have any like deep, dark questions you want to ask Alyssa. Alyssa is our Director of Student Aid, and she has been at the university for how long now, Alyssa?
I've been at Slippery Rock since 2015, but I've been in higher education financial aid for 20 years now.
Absolutely. So we're so excited. My name is Kelly. I'm the Alumni Director, and we are excited to welcome you tonight to this great presentation about the ending of the COVID-19 repayment pause. So unfortunately, that means rent's due again. And Alyssa is going to talk all about how to go through that that whole process. And we'll go ahead and get you started on that right now. So Alyssa, at this point, I'm going to turn it over to you.
All right, sounds great. So we are going to be talking about the end of the repayment pause, and I know that it can be a scary time for folks, and there's a lot of confusion surrounding all of this, not just from us and from borrowers, but also from the Department of Education and even from the loan servicers who are servicing these loans. So hopefully, by the end of this presentation, you'll have a better grasp of sort of what is going on with your loans and also what you guys need to do as loan borrowers. So this is just a big scary list of all of the places that this information came from. As you can see, there's several different highly technical kind of legalese documents that the Department of Education has put out that govern all of these rules and stipulations and the way in which we have to begin repaying the student loans. And this is probably the reason that there is so much confusion out there, as well as difficulty navigating all of the systems. So where are we right now? Here we are in October of 2023, and approximately 49 million federal student loan borrowers will enter repayment this month. That's a huge undertaking, to say the least. One really important thing that you should all be aware of is that this is not a capitalization event. Prior to the pandemic, anytime your loans entered into repayment for whatever reason, whether that was an in-school deferment, a forbearance for economic hardship, it would have been a capitalizing event. This was not. So what does that mean? Well, during the entire repayment pause, no interest should have been accruing on your student loan. So if your balance was $10,000 in September, when they sort of turned the switch back on, it should have still been $10,000 and there should have been no interest capitalization. However, interest did start in September, and we'll take a look at what that means or what that looks like in a slide or two. So what might you need to do right now? You might need to certify your income, sign up for an income-driven repayment plan, maybe even reset your studentaid.gov account or your loan servicer account, and perhaps even update your bank info if you are the type of person who likes to do auto draft for your payments. And that brings us to, you should also be looking at studentaid.gov because all borrowers are assigned a federal loan servicer, and those are all different. It will depend on the type of loan that you have, how old your loan is, where you went to school, if you're on public service loan forgiveness. But what is common amongst all of us is that we do have this student aid. It's over here. It's in the blue. This is a little bit hard to see for me. Hopefully it comes through better for you guys on your end. But all of us have an account at studentaid.gov that we can log in that has all of our, not even just our loan information, but our grant information as well. And what I love about our accounts at studentaid.gov is that it doesn't matter where you went to school or how many different schools you may have gone to, if it's one school or 3 or more, all of your information is aggregated here. So even if you borrowed at several different schools, you can still find good, accurate, and aggregated information at that one spot. So it really is great. That's where you're going to want to begin your journey if you have not already done so. So there are a lot of things happening right now with your loans. I briefly touched on some of them on the previous slide. And I did say that beginning in September, even though our payments didn't start in September, our payments start this month, but in September, interest began to accrue on your student loans once again. So as an example, and I'm going to preface all of these examples with, I used a high loan balance because people with high loan balances often wonder, what does this mean for me? I know I've borrowed so much. And people with lower loan balances can say, well, at least it's not going to be, I know it's not going to be that high. And then, if you do have questions that you want me to help you with your own loan balance, we can talk about that at the end. But for this example, again, relatively high loan balance. Maybe they went to a couple of schools, maybe they went to graduate school. So a $200,000 loan balance at 6% interest, which if you've consolidated, they're going to aggregate all of your interest rates together, would equal $12,000 for the year, which would mean $1,000 monthly interest accrual. So if you had a $200,000 loan balance in the month of September, $1,000 would have been added onto that loan balance, but no additional fees. Remember, this is not a capitalizing event. Just simple interest should have been accruing in September. So you shouldn't see a large increase, just that small interest accrual added to your loan for that month. So what else is happening? Well, you're going to be placed on a standard 10-year loan repayment plan if you have never chosen an income-driven plan, or even if prior to the pandemic you had already chosen an income-driven plan. If you did not recertify your income, they're going to revert you back to that 10-year standard repayment plan. And so one of the things that we're seeing happen, and one of the panicky questions that we're getting from our students is, oh my gosh, I'm not sure what happened, but all of a sudden after the pandemic, my loan payment is so much higher and I don't know what to do. What I have found is that those students had chosen an income-driven repayment plan prior to the pandemic and then lapse in their income recertification. What you need to do at that point is go to studentaid.gov, recertify your income, and I would also advise to switch to the SAVE plan. We will be discussing the SAVE plan, and it is the most, at this time, in my opinion, it is the most favorable income-driven repayment plan to sign up for. And then this last bullet is really, really important. If you are considering consolidation, and there are a number of different reasons why you could consider consolidation. Maybe you went to school during the pandemic. Maybe you went to graduate school and never consolidated your undergraduate with your graduate loans. Maybe you just don't like tracking that many different loans. Or if you were working towards public service loan forgiveness, and even though you weren't making any payments during the pandemic, if you have loans that are not consolidated together, you have to consolidate by the end of December in order to have your highest payment count for all loans. So let me try to break that down a little bit for you. Let's say you have a loan from your undergrad that you've consolidated, and you have all 3 years of the pandemic where we were not making payments are going to count towards that loan, but all your prior payments are too. And let's say your repayment count on that is 80. You've already made 80 payments on that old loan. And then you did some graduate study, maybe during the pandemic, maybe just before the pandemic, and those loans are not with those older loans. You need to consolidate, because what will happen is those older loans that you have not made 80 payments on will combine with the loans, and your loan payment count will be the highest out there of any loans that you have paid on. So essentially, in order to receive the highest payment count for all loans, you do need to consolidate by December 31st. Another consideration for consolidation is if you have old and FFELP right here. We reread everything in financial aid. I'll try to explain what they mean, but those are loans prior to 2010 generally, and it just stands for Federal Family Education Loan Program. And those are just older loans, again, prior to 2010. You're going to want to consolidate those as well in order to allow you to achieve public service loan forgiveness or to get on the SAVE plan. So what is PSLF? PSLF is Public Service Loan Forgiveness, and it is a special way in which to repay your loans that will ultimately allow you to have your loan balance forgiven after 10 years of payments. Now, the unique thing is that during the 3-year payment pause, all of those payments that were technically nothing, because nothing was required, will count. And that's 36 payments that count towards the 10 years. 10 years of payments is 120. You need 120 total payments, and 36 of those are sort of freebies because they were given to us during the repayment pause. There's a special page that is a help tool for public service loan forgiveness, and it is studentaid.gov/PSLF. You can do a bunch of different things here. You can check to see if your employer is already in the employer database. So as an example, I went in there to check to see if Slippery Rock was there because, oh, there's my cat. Because we are a public institution of higher education. He advanced the slides too early. Sorry. And it is, Slippery Rock is listed there. Any other public school system should be listed there. You can also, if you think your employer should be included, you can send an email from that site to request that your employer be reviewed to see if they do qualify, because they don't have to be a public entity like Slippery Rock. It could be a nonprofit that's private. So as an example that I'm familiar with in the world of higher education, my friends that work at Mercyhurst, which is a private institution, but because it is nonprofit, people that work there can also qualify for public service loan forgiveness. The other things that you can do there is you can prepare, and this is new, you can prepare and sign your PSLF form, and then electronically send that to your employer for electronic signature, which makes it really easy. Batman, stop it. Which makes it really easy to get that part done. I do encourage everybody to fill out a PSLF form every year. That's going to make sure that you're on track. Again, you're only going to be required for 10 years. If you had been paying prior to the pandemic, it's going to be 7 years or less that you're required to pay back on these. It does another check to make sure that your employer does qualify. And then it requires that your loan servicer update your repayment count as well. So I encourage you to do this every year. If you haven't done it in a while, go ahead to the studentaid.gov/PSLF and get that done as soon as you can. So we also did mention very briefly that SAVE plan. It's another acronym, and it stands for Saving on a Valuable Education. You can read about it if you go to this link right here. But essentially, and I'm sure you've heard about it in the news, it's kind of the new big deal as we enter student loan repayment. It is an income-driven repayment plan. So that simply means that your payment is going to be tailored to your income and your family size to make it reasonable for you to make your monthly payments on your student loans. Under the old income-driven repayment, so if you were on one before, the income protection allowance was 150% of the federally published poverty guidelines, and it is now 225% of the federally published poverty guidelines. So that's a large increase. What that means is that your loan repayment amount should be decreasing under this SAVE plan. And this is probably the best news that I've experienced in my 20 years in higher education. There's an interest subsidy that is now 100% of unpaid interest, which is amazing. So what that means is if your payment that they calculate based on this new 225% income protection is not enough to fully cover the interest on your federal loan, they will cover what it does not. So your loan balance will never grow. This was a huge problem prior to the pandemic. It was one of the issues that so many folks were ending up struggling for so many years and eventually going into default. So we will look at an example of what that interest subsidy means, and I think it will sort of help solidify that concept for you on the next slide. And then another huge benefit is that for married people, if you file taxes separately, then your income is considered separate. So this is a little bit tricky. If, like me, your background is in accounting, it'll be easy for you to kind of prepare your taxes. If you're married, prepare your taxes both ways, but then also take a look at income-driven repayments in both ways if you're both borrowers. But there's going to be a lot to consider come tax time if you should file separately or together and beyond the SAVE plan. So here's what it would look like for a household size of 1. And for this example, I'm using an annual income of $65,000. So for 2023, we used the poverty guideline household size of 1. This is a single person. The poverty guideline right now for a household size of 1, if you're at $14,500, if you're below $14,580 and you are considered living in poverty, so we take that times 225%. So that means that you would get to keep $32,805 of your income before you would have to pay any dollars at all on your federal student loan. So before we go any further, what this means is that under the SAVE plan, a single person can make $32,804 and not have to pay any dollars on their student loans, and it would count as a payment on an income-driven repayment plan, even though the payment is zero, because it was calculated based on that save repayment plan. I want you to pay close attention to this example because you may or may not have seen the most recent news where hundreds of thousands of people's payment on the save plan was calculated incorrectly. And it's now a known issue, so they're getting revised payment amounts, but it's really easy to do the calculation yourself. You look up the poverty guideline on the federal poverty guideline tables, and the calculation is here for you. It's not a very difficult one. If you need help, reach out. I'll help you. Somebody will help you. Just to make sure that your payment is accurate. So what you would do then is you take your annual income. Remember, this single person made $65,000. We subtract out what is protected. That leaves this remaining amount of $32,195. You are required to pay 10% of this discretionary income, is what we call this income that is above 225% of the poverty threshold. We call that discretionary. And you're required to pay 10% of that to your student loans. That's going to equal $3,219 for the year. Divide that by 12 monthly payments. So under the SAVE plan, a single person with an annual income of $65,000 would be required to pay $268 monthly, regardless of what their loan balance is. Regardless of what their loan balance is. Under the SAVE plan, they only look at your income and your household size to determine that loan payment. So, if you recall, I did say we would look at that interest subsidy, and I think this will help kind of solidify that concept and what it actually means and how helpful it really is. So we're going to use, in the very beginning, I used that wildly high balance of $200,000. So we're going to use that, our borrower who has that high balance aggregate of all of their student loans combined, $200,000. And so that would mean, if they had that 6% interest rate, simple interest, that $1,000 of interest is accruing monthly. So we're going to use the payment plan that we just calculated previously. So this person borrowed $200,000. They're single. They're making $65,000 annually out there. So, but $100,000 is accruing monthly just of interest. The payment that we just calculated is only $268. So that means that under the old system, even though they made a payment, $732 would be adding into their loan principal every single month. So you can see how quickly that would balloon. But under this new loan program, this new loan repayment program, the Department of Education actually subsidizes the entire $732, and your loan balance stays the same each month. That is huge. Now, some people say, "Ew, that doesn't sound great. Like I'm still not getting anywhere. I'm still not making any my payment or my aggregate loan balance is not decreasing at all. I'm just paying interest to the department for no reason." But depending on your loan balance, for very low loan balances, or if you're on public service loan forgiveness, or even if you're not, your loans will be forgiven either within 10 or 20 years. It depends on a lot of different factors. Only your loan servicer can determine which where your light at the end of your tunnel is, whether it's going to be a 10, a 15, or a 20-year path to loan forgiveness. But so even though in this example, that loan balance, that whole $200,000 is never going to go away. It's going to stay $200,000 the whole time. It's still going to be forgiven at some point. So it's still not the end of the world, even if your loan balance is not decreasing. It is now no longer going to be increasing, which is the huge, really helpful change. And I hope that example kind of shows you exactly what that means and how big of a change that really is for folks. So which loans are eligible? A lot of different loans are eligible, but there are some that are not. So any direct subsidized or unsubsidized loans, any graduate plus or professional graduate plus loans made to a student are eligible for the SAVE plan, and any consolidation loans that did not repay parent plus loans made to parents are eligible. Other loans may be eligible if they are consolidated, which again, one of the things I mentioned in the very beginning of this presentation was how important consolidation may be. So if you have any of these types of loans here in the middle, you're going to be one of those people that definitely wants to consolidate and wants to consolidate prior to that December 31st deadline, end of this year. And then ineligible loans, and there's nothing we can do about that currently, although there's always some movement in Congress if you're the type of person that likes to lobby for and do some advocacy for student loans. But currently, plus loans made to parents, consolidation loans, that repaid plus loans made to parents. These loans, FFELP loans and Perkins loans, might not be eligible if you don't consolidate. So you can remove these from this column easily just by consolidating. Currently, though, in their current state, not eligible. And then any loan that is currently in default is also ineligible. But there's some really nice programs that assist people in getting out of default too. So if you do have a loan that is currently in default, but yet you want to sign up for the Saves Plan, you can do that. You just need to contact your loan servicer so they can pull that loan out of default in order to allow you to move over into this eligible column. So most loans are eligible. And then if they're not, hopefully they're in this middle column and you can consolidate them or contact your loan servicer to get them into that eligible column. So what does all of that mean? Well, if you remember in the beginning, we kind of looked at what's happening right now. And one of those, the final tab did mention, studentaid.gov. So what you should be doing right now is logging into studentaid.gov, making sure that your username and password are current, updating them if they're not, making sure that your contact information within studentaid.gov is current, meaning your mailing address may have changed, your email address may have changed. Make sure all of that stuff is accurate because all of these things and moving parts are really important and they're going to be trying to communicate with you and maybe even vice versa. And then also ensure your federal loan servicer has a current info. Remember, if you recall, all of us have an account at studentaid.gov, but then our federal loan servicer may be different depending on the types of loans that we have and whether or not we're in public service loan forgiveness. One helpful tip that regarding loan servicers is that if you think you are in the public service loan forgiveness program and your servicer is not MOHELA, then you have an issue. You do need to get logged in. I would start here. I would let them know here that you're interested in public service loan forgiveness because all of the loan borrowers who have indicated that they are interested in public service loan forgiveness or who have submitted a public service loan forgiveness form will have MOHELA as their loan servicer. If you're not sure who your loan servicer is, again, start here. But if you know for sure it's not MOHELA and you think you're in public service, you need to get that cleared up pretty soon. And it probably is going to mean consolidating as well. And before we go into this part, though, I want to say that was a lot of information. I appreciate that. I think all of you hung in there for it. It's a little bit complex, and I'm sure that you may have questions, but I do want to stop recording at this time before you ask questions, just to give you the freedom to be able to share your maybe personal in nature questions. So Kelly, if you can just go ahead and confirm when we are stopped.